Hello, welcome to this episode of Rich Insights. I'm Don Rich, Head of Investments for Esoterica Capital Management. Today's topic is the direction of interest rates, the future direction of interest rates. Now, we held a similar topic back in January, and at that time, I thought interest rates were going lower, and lower they did go, right? Long-term interest rates, 10-year interest rates in the U.S. have fallen about 120 basis points since then. 120 basis points. So where are they expected to go from here? Well, I believe they're going higher from here. All right, and we'll walk through the reasons why. Now, the reason I'm talking about this is because we just come off the longest expansion period in U.S. history. It's somewhere between 10.5 and 11 years, depending on how you measure it. The longest one in history. So it became easy to forget about fixed income, to forget about the safer investment class. But we're no longer in the bull market. We're in a bear market now. And we have to adjust our asset allocation to reflect that. Okay, so the two easiest ways to generate income, right? Generate investment income or build wealth so far this year. The two easiest ways were to short equities or to buy bonds. All right, let's take a look at this. When you short equities, by the way, you're selling equities and hoping to buy them back at a lower price. All right, that's the concept of shorting. So let's look at our equity returns. These are year-to-date equity returns as of April 3rd from around the world. Okay, so we have some U.S. Indices here. You see the S&P 500. Here's the Dow Jones Industrial Average. And you have a number of non-U.S. companies. What do they all have in common? They are down significantly. Generally 20+% for the year so far. All right, what about fixed income? Well, long treasuries, right? Long-dated treasuries are actually up 24%. So while equities are down 20+%, long bonds are actually positive 24%. Now look at here, the so-called Lehman Ag. This is the cap-weighted index of the entire U.S. bond market. So it has treasuries, it has the corporates in there, it has mortgage-backed securities in there. You can see it's up about 3.5% for a year. The big underperformer here is high yield. All right, high yield has very short duration to it. One of the shortest duration fixed income products. Tends to be about 3 years. All right, so it has very little interest rate risk. So even though interest rates have gone down, high yield hasn't benefited much from that. It has very low interest rate risk. But it also has very high equity sensitivity to it. All right, that's why high yield has been underperforming. So it's important to know not only if you're investing in fixed income, but which asset class you're investing in. You have to know your holdings. Okay, so that's all in the past, right? We know equities are down, fixed income's up. Where do we go from here? Well, my guess is rates are going higher. Let's walk through the reasons why. The first one here, a reduction in the recycling of petrodollars. What the hell does that mean? Well, when we, first of all, everything in the energy market is denominated in U.S. dollars. So when we buy oil or energy products outside of the U.S., we pay for them in dollars, and they will often take those dollars and reinvest them back in the U.S. That's called the recycling of these petrodollars. Now, two things are affecting the recycling. One is today we're 60% self-sufficient. 60% self-sufficient in terms of our oil consumption. So we're not nearly as reliant on these foreign oil producers as we used to be. And the second thing is we have $20 oil. So even if we were still reliant at $20 oil, there's far less petrodollars that would be recycled back into the U.S. system. The second bullet point here is a reduction in the recycling of trade dollars. All right, this concept works the same as petrodollars. China has a peg currency. We buy most of our imports from China. So when we buy those imports, we pay for them in dollars, and China will often take those dollars and plow them right back into the U.S. by buying treasuries. Now, why do they do that? Well, if you have a peg currency, you have to control the money supply, and you can't have this influx of dollars, right? So if we buy these foreign products, they'd have an influx of dollars, and it'd be tough for them to maintain the peg. So they get rid of those dollars as soon as they come in and make the problem go away. Well, the recycling of these trade dollars has collapsed because the coronavirus has brought the global economy to a screeching halt. We don't know it yet. It'll take months before the macroeconomic data tells us, but we are most likely in a global recession right now. There's far less trading going on. So we don't have those recycling of trade dollars. Number three here, the third reason, liquidity is improving, right? The credit channels are opening up. The ability to obtain credit, to obtain dollar funding is getting easier with all the facilities that the Fed has set up. So the flight to quality, the demand for dollars, the demand for safe haven instruments is going down in the future. Now, the fourth bullet point, I'm going to go back to the chart in a second, but the fourth bullet point, you say, Fat Man, Congress just passed a $2 trillion package, stimulus or relief package, whatever you want to call it, $2 trillion. Now, we were already spending $1 trillion more per year than we make, plus the additional $2 trillion. How are we going to pay for this? Obviously, we're going to issue a bunch of debt. Isn't that going to have an effect on interest rates? Well, most of that new issuance is going to be neutralized by the Fed through their quantitative easing program, right? They had a tremendous expansion in the quantitative easing program. So a lot of that's going to be neutralized. All right. And then this fifth bullet point here. So if rates are going higher over the next few months, obviously you can play that, right? If rates go higher, that means bond prices are going lower. And you can position tactically to take advantage of that. The other way to do it is think longer term. I call it think proactively. Eventually, we're going to require negative interest rates in the U.S. Negative rates exist in Europe. Negative rates exist in Japan. They exist elsewhere. I believe they're coming to the U.S. as well. So even though in the short term, I think rates are going to rise, in the long term, they're even going down further than they are today. So we could use that run up in rates to our advantage. Run up in rates means those bonds become cheaper. All right, so we can load up on tail risk hedges as rates go higher, as one possible strategy. To load up on our hedges, load up on our tail risk. Now, why is it? Why are we going to have require negative rates? Well, we're going to need something called debt deflation. Debt deflation. We are going to have a tremendous debt burden when we get past this coronavirus. Just a tremendous debt burden. And the negative interest rates are going to allow us to issue new debt to pay off the old debt at cheaper rates. It becomes cheaper and cheaper to do so as interest rates fall. And that's the only way that I can foresee that we're going to be able to manage the debt burden we have today. So again, in the short term, over the next few months, rates should rise for the reasons why. Longer term, I suspect rates are going to fall. All right, so that's our message for today. I'm Don Rich. You just experienced a rich insight. I hope you've enjoyed this. May your beer be colder than the company you keep. We'll talk again soon. Thank you.